Hey, everybody. Tom Gentile here, resident pattern trader, hanging out with you. It's Monday, March 2nd. What do I want to do with you today? I want to first talk about, I want to talk about the fact that we're now in the month of March. So we've got the money calendar, we've got our seasonal calendar, and I'm going to talk about a couple of stocks. We'll look at the calendar going into the month of March. So we'll talk about the first week of the calendar. Also, I got 3 breakout stocks that I want to talk about. They're on the radar as we head into spring. Let's call them the spring breakout stocks. And then finally, and this is a big one. A lot of you found out about this last week, but after 28 years, now I've been trading longer than 28 years, but after 28 years, I have made a huge pivot in options, all right, when it comes to options platforms. And we're going to discuss that as well as we get into the day. So I want to welcome all of you. If you're brand new to us, all right, check out patternsandprofits.com. I've got articles, I've got education, I've got some free reports on there that you're going to want to see. And we add reports on a regular basis, all focusing on one area, which is seasonality. So want to make sure that you have all of that information at your fingertips. Again, patternsandprofits.com. So let's talk scorched earth in the Middle East, because that's what a lot of us have been waking up to. If you didn't already see it this weekend, there was a massive escalation in the Middle East, military strikes by the U.S. and Israel against Iran or the Iranian government. So this, this has been going on for months now. But on Saturday, right, U.S. and Israel launched a coordinated large-scale offensive. They called it Operation Epic Fury. Some called Operation Roaring Lion. Basically, they were doing a couple of things. They were targeting leadership. And as you know, the supreme leader, Khomeini, was killed. There were strikes that were hit, I think 500 strikes against military targets in the region. And of course, Iran didn't go quietly into the night. They responded too. They hit a lot of areas where we have U.S. bases. They hit the UAE, they hit Qatar, they hit Bahrain, they hit Kuwait, they hit Jordan. And there were some civilian casualties and even civilian targets that got hit in the crossfire. Resorts, I know that one of the Palm resorts got hit. The Fairmont Dubai got hit. My wife and I were actually planning a trip to Dubai, and we're going to stay at the Fairmont. And as of now, obviously, those plans have been put on hold. Now, as of today, situation's still volatile. I expect it's going to be, at the very least, until Iran has really kind of depleted its weapon arsenal. And so, with that, I want to tune into the money calendar, because we've all seen the news. I don't want to get into the news of Iran. You can click on a million different channels to see all that. I wanted to headline it and set it up for something that we've been talking about for weeks now. All right. And we're going to talk about, I'm going to talk about it continually. But what have we been talking about for the last few weeks? Really, since we got out of January, what we talked about in February. We talked about this. First of all, we talked about the uncertainty that came into February. Yes, the money calendar is mostly bullish. But what's happened is we've gone from January, where 90% of what I was looking at was bullish and maybe 10% was bearish, to coming into February, that season changed. And, as we're entering the month of March, you can see here, we've got one third roughly of my money calendar scans, if you look across here, are bearish. All right. 67.33 for March 2nd, 65.35, 67.33, 68.32, 67.33. What does this mean? This means that 2/3 of what I see is bullish and 1/3 is bearish. But it's deeper than that, because when I go in, I start doing research, I start looking at the days, the actual days, and I start looking at stocks and ETFs that come up. The stocks that are bullish are not tech stocks. They're not what you and I, are typically looking at. AI is not in the bullish camps right now. You know what's in the bullish categories? Safety stocks. What have we been talking about for the last weeks or even almost a month now? Safety stocks, okay? And that means safety is key, and it continues to be. It means that what I'm bullish on are stocks and ETFs that go up when the overall market goes down. So what have we been covering, guys? We've been talking about utilities. We've been talking about metals, all right, precious metals. And yes, most recently, the last couple of weeks, we've been talking about oil. So what's the global impact of what happened this weekend? Prices of oil have spiked. We're going to take a look at those prices in just a moment, but uncertainty is just escalating. And like I said before, if you've been with me, I've been talking about oil and energy for weeks now. But I've also said this isn't about predicting oil. It's about recognizing the seasonal window and trading it. And one of the most reliable trades on the calendar that I showed last month and I'm showing now is setting up again. And what am I talking about? I'm talking about the mid-February to mid-July calendar. And I'm not going to go through the details. We did that last month, okay? But things are moving. Things are moving, and what's going on in the Middle East is just escalating that movement. So for those of you that are just seeing this for the first time, what are we talking about? I'm talking about a pattern in oil and energy, begins in mid-February. It typically peaks in mid-July. It has delivered gains in 8 of the last 10 years. As you see here on my screen, I'm talking about, in this case, USO, which is an ETF that trades. The majority of the ETF is centered around oil. There's a little bit centered around gas, but oil and gas typically move in the same direction. And 8 of the last 10 years, USO has gone up. It's been higher mid-July than we started in mid-February. Folks, this is what we call a pattern, a repeatable pattern, okay? Again, what do? I spot repeatable patterns. Then I look to trade either the asset or an alternative version of the asset. And it's just a matter of planning, executing, and managing, okay? So spot, repeat, trade. That's what we do. And this is the trade that has been in question. We started talking about this weeks ago, but now everybody's talking about it, but they're not talking about the pattern. They're not talking about the 5-month pattern. They're talking about what happened over the weekend. And they're talking about that big jump, okay? So let's look at USO. Here's USO. Here's a 6-month chart of USO, and I want you to pay particular attention to over here, to this area, which is the gap that happened between last Friday and today when we jumped from the low 80s to the high 80s. That's how quick it happened. Markets were down 500, 600 points on the Dow at the open of the day. They've since come back. They're down still, but not where they were, because this market is a knee-jerk reaction market. But forget about the day for a moment. I want you to see what's happened here. In the month of February, we've broken out of that 74, 75 area of resistance that we've been in for months now. And we've broken out to 80, and then we consolidated in 80. Now we've broken out to the mid-80s. And so my expectation is this is going to continue. The outlook's going to be higher. The volatility, that's the red line you see on the screen, right? The implied volatility. What do option traders think? Option traders are very nervous right now, and they're pricing option premium higher than I've seen it in quite some time. Now, there are multiple ways to profit from this if these patterns continue. Number one, we could look at this pattern right here, USO. We could simply buy shares of USO, all right? That's the exchange traded oil fund. It tracks crude oil. It's actually something you can trade right out of your stock account. If you've never seen it before, USO, that is the symbol, okay? What I've seen over years and years, and I mean, you could go back into the 70s, 80s, 90s. This pattern in the last 10 years has been 80% accurate. What happens is during the winter months, all right, we see a softening from mid-July all the way up into the winter months of mid-February. Then, you know, at that time, what's going on? Well, demand is coming off, supplies are building, and then right around that mid-February area, the tone starts to shift. The pattern kicks in. Refiners, they're preparing for driving season, but as much as they prepare, demand expectations rise. Okay, as that happens, crude oil starts to go higher. We build momentum into the spring. More often than not, strength carries through to early summer before, again, everybody's talking about it. In mid-July, that's when the top happens, when everyone's talking about the driving season, the price of gas, the demands. Because remember, the market's always going to be ahead of logic. And over the last decade, this mid-July stretch has finished higher 8 in the last 10 times. So this is one way that we could look at this. All right. We could look at USO. Now, I want to give you 3 stocks. I talked about them last month, but I want to highlight them here for those of you that may have missed. It's because guess what? They all 3 didn't start weeks ago. In fact, 2 of them are starting in the next few weeks. So I want to make sure you have all this information handy so that you can start to capitalize on these patterns, these repeatable patterns. And although they're not 100% repeatable, I don't guarantee they're going to be 100% repeatable. I'm a pattern trader. If I see something happening over and over and over again, that's the area I'm going to lean into. So let's start with what I like to call patterns inside the patterns with the first of 3 stocks. All right, so number 1, NEE. This is Nextra Energy. So Nextra Energy has already started its pattern, and actually started it a couple weeks ago when we started highlighting the oil and energy pattern. So this one's already kind of in play. The window of this pattern is about a 32-day pattern. How often has it worked? Well, in the last 20 years, excuse me, I'm using 20 years of data on these stocks. 17 of the last 20 years, Nextra Energy has moved higher between now and April 1st. Okay. And if you look at the 17 times it's won and the 3 times it is lost, all together, winners and losers combined, it's made an average move of almost 3%. Now, you might say, Tom, 3% isn't that much. Actually, you know what? In 6 weeks, 3% is quite a bit when you look at it on an annualized basis. But you can do better than that too, if you're looking at outside of the stock. But as of right now, let's talk about the stock. So historically, Nextra starts to lift right around the time that oil starts moving. And it's posted, like I said, 17 the last 20 years in this window. It's consistency, but it's not random. Okay? It's a repeatable pattern. It's a repeatable edge. Again, started a couple weeks ago, but take a look at it. Nextra Energy, NEE. Next of the 3 stocks I want to talk to you about, how about EOG Resources? So EOG Resources doesn't start until March 13th. So I'm giving you a 2-week head start on this one, because you might be looking at some of this and saying, well, Tom, I missed the oil and energy pattern. Tom, I missed Nextra Energy. It started after President's Day. President's Day was 2 weeks ago. Here's one that doesn't start for 2 weeks. All right. So on March 13th, we see EOG and EOG moving higher into mid-May, into beginning of May 7th. All right. During this run, in the last 20 years, EOG moving higher between mid-March and the first week of May. Well, how often has that happened? How about 18 of the last 20 years? That's a 90% historical win rate. 18 of the last 20 years, EOG has moved higher, March 13th to May 7th. Well, what kind of an average move are we looking at? The 18 winners and the 2 losers combined saw an average move of about 9%. Okay. So what I'm saying is, over the seasonal window, EOG has finished higher in 18 of the last 20 years with a 9% average gain. This is the kind of alignment with the broader oil move. And it's something that You just simply cannot ignore this kind of a move. Okay. So number 3, Suncor Energy. All right. Let's talk about Suncor for a moment. It has a seasonal start date that doesn't start till the end of March, March 27th. So put that on your calendar. March 27th to April 30th. How about the win rate here? 85%. Okay. That means that in 17 of the last 20 years, Sun has moved higher between March 27th and April 30th. Now, as oil moves up, Suncor tends to participate right alongside it. And the track record that we've seen points to a dependable seasonal tendency, all right, in oil, rather than just a one-off move. Okay? So, again, let's just do a quick summary of this. What am I talking about here? I am talking about a summary of energy and oil patterns. Patterns within the big pattern. The big pattern, 5 months. These are all 4 to 6 week patterns when you put them together. So I'm looking at an extra energy. That started on February 17th. I see that playing out till around April 1st. And again, EOG, March 13th. That doesn't start for a couple weeks. That runs out to May 7th. And Suncor, March 27th to April 30th. Again, how do I know all this? All right. Do I keep a ledger of sorts? Do I have legal pads that I'm constantly writing on? No, I'm not there yet. Right. In fact, I'm much more efficient at that because I have data. I have all of this data at my fingertips, 10, 20 years or so, where I can go in and I can do the research and I can find the best stocks with the best patterns, the best entries, and the best exits. Now, if you want more, okay, if you want to see this research and you want to see stocks every week, all right, outside of just oil and energy stocks, etc. If you want that, you can get all of my stock, right? All of my research, all of the days, the entry days, all of the exit days on stocks, on ETFs. How about for less than $1 a week? That's what we're doing right now. Stock Cycles Trader. This is my weekly seasonal alert service where my team and I do all the work for you. We do the research, right? We do the vetting, and you get the best stocks. You get the entry dates. You get the exit dates. And like I said before, I can't guarantee the future, all right? I'm not Miss Cleo. I can't guarantee the future. I don't have a crystal ball, right? But everything I do is based on repeatable patterns. And everything that we share with you is based on and backed by decades of data with historical win rates, in the case of stock cycle traders, of 90% or better. Some 100% historical win rates. So if you want that kind of information, if you want that at your fingertips, you can get it for less than $1 a week. Click on the QR code beside me, and you can take advantage of that special offer. Now, I don't know how long we're going to leave that up, but it's something that we're doing now that's available to my group, and I want to make it available to you. So check it out. So after 28 years, I made a huge pivot. If you've been with me for any great length of time, then you know my story. I mean, when I started trading, and this is in my 20s, early 20s. In fact, I couldn't trade earlier than 21 because my parents, smart as they were definitely smart enough not to co-sign on a stock account with me. And that was a smart move on their part because, my pattern then was like everyone else's that gets started in this business. Watch that, listen to the emotion and the hype, and then trade whatever the guy on TV was saying to trade. And unfortunately, I didn't realize it then, they didn't have a skin in the game. Right. So I had to make a decision long ago. And that was, did I want to continue to go down this road, or did I really want to understand the business of trading, and more importantly, how to profit from it? And so that began my 10-year which went from my parents' home to the American Stock Exchange. I left a good lucrative job in IT to go to the American Stock Exchange, and I worked for a local firm there. And I learned options. And I learned that there was so many other avenues to trading other than just buy it here and sell it there on a whim or on a meme. Wasn't called a meme back then, but that's basically what it was. So here we are now, and over the course of the 90s, since the 1990s, all right, we have had a product through Optionetics and through Tom's Trading Room that we actually had a product that was options analysis, Optionetics Platinum, Tom's Option Tools. This was a product that resided on the Unix platform. Most people, when they think of software, they think of Microsoft, all right, Microsoft Windows. Remember Microsoft Windows? And they don't call it Windows anymore. It's just Microsoft.com. But then, migrated toward the Mac. The Mac used to be, in my mind, it used to be the outlier. Now it's really become the center because it's easier to use. And then, we've got more cloud-based software now too. And so we made a big leap because we have moved away from the Unix software. We had to move away from it. It was ending. It's basically breaking down. And so we had to change with the times. So I made a big pivot when I pivoted to cloud-based software and pivoted my option platform and my scans and the things that we do to hub.com. And so you're going to be hearing a lot more out of this. But what I'm going to be doing is I'm going to be utilizing this on a weekly basis. And my plan is to kind of show you how we create alternative risk trades, but I'm going to be showing it to you right in here. All right, right into the Hub software. And as you can see on the screen right now is my money calendar. And I'm going to go through this in a different on a different day. But we have the money calendar in here. We have all kinds of tools all loaded up and more coming throughout the day, throughout the weeks. And so that being said, I want to take what we discussed in oil and energy, and I want to show you how you can navigate through just a couple of things, as we get to the end of our program today. So let's start with a chart. And so I'm going to blow this up where everybody can see it. And I've got a chart all ready to go on here. So I showed this chart at the beginning of the program, and this was a chart of USO. So I'm looking at USO, and I see that it's up substantially from where it was on Friday. You can see the big gap that here's Friday, and then here's our gap of today. But, again, and I have all kinds of abilities I can do on here. I can squeeze this in. This software gives us the ability to do things that we couldn't do with the Unix platform. What do I have on here right now? I can put a multitude of things on the chart, but right now I kept the chart clean. The only thing I want to see on the chart right now is the price and then this red line. And this red line is not a moving average, okay? It's not a moving average. Again, I'm not a big fan of all the squiggly lines that are out there. Moving averages, MACDs, convergence, divergence, all that stuff. I like volume. I like volatility, right? And then I also like seasonality, as you know. But I also like to look at statistical volatility. So I'm a big fan of volatility-based trading. So when I look at this, maybe I might throw out there a volatility cone to give me an idea of the range or that expected range that the stock or ETF in question is likely to go, right? Based on not only could look at statistical volatility, but I could base it on implied volatility. Just gives me an idea of where it's likely to go in the future. Right, that's one area I could go into. There's another area that I like is a contrarian view, looking at Elliott wave. All right, Elliott wave is very it's often unused. It's not the easiest thing to use. Right, has a lot of subjection to it. If you have a program that could strip out the subjection, that might help. It helps me tremendously. When I look at LA Wave on here, it's telling me that oil is in the beginning of an institutional phase where you see a lot of big volume coming in, stepping in, buying USO and buying oil, because they believe that even though there's a pullback that could be coming here, and it could be coming later this month, but that the pullback may be short term, that we may see long-term moves. Because once again, I don't think Iran or anything goes quietly into the night. And like I mentioned before, Joe, that red line is implied volatility. It's what the option traders are thinking. And you know what the option traders are thinking right now? Option prices are expensive compared to where they were. If you look over here to the left-hand side, you can see the percentages. And these are percentages that are based on what option traders believe these moves are likely to happen in the underlying stock, and they price that into the time value. So without getting too nerdy on the options formula that it takes to create this, I can tell you this: when you see it down here at a 30, and then you see it upwards of 56 heading to 60, what this tells me is that at the beginning of the year, time value on USO was almost half of what it is right now. You're paying double for time value. All right, right now in the month of March than you were at the beginning of the year. That's what that red line tells us. And that's not something you can get everywhere. It's implied volatility. It's based on, you got to have an option data, and you have to have the right way of calculating that option data to get that value. Now, we can do a number of things with this. All right, what I can do is I can now take that, and by the way, that's different for every stock. That's not an average. That's not the VIX. The VIX is the S&P 500. The volatility on the 500 stocks, the S&P 500. This is the value of USO. This could be the value of Apple. All right, let me throw Apple up here, AAPL. And you can see Apple's going to pop up on the screen. And let me just reset it here. But take a look at Apple. And you can see here, this goes back to the summer of last year. But you can see Apple's move up. And you can see option value going down. But what's happened to Apple? Apple has now created lower highs. It has higher lows and lower highs. It's coming into an area where option traders are a little nervous because they don't know whether Apple's going to break to the upside or break to the downside. So you know what they're doing? They're bidding up the option prices. They're saying, we don't know, so you're paying more. And so we need to know that, all right, if we're going to delve into options, because I don't want to buy call options on USO, and I might not want to buy call options on Apple because they're more expensive now. They're about 40% more expensive now than they were at the beginning of the year, right? So we take all of this into account. Spotting opportunity, all right? That's number one. And so spotting opportunity means if you're a trend trader, you're looking for trend breakouts. Maybe you're a seasonal trader like me, and you're looking for things that seasonally move up between a start date and an end date. That's just the beginning. Because if you're going to be an option trader, you need more than just, for one reason or another. I think it's going to go higher. I think it's going to go lower. You could be right on direction. And if you buy an overpriced option, you could be wrong in terms of profit, right? I'm not the first person. And I know there's a bunch of you that are out here that can agree with me on this statement. How many of you have bought a call option on a stock that the stock actually moved higher, but it didn't move high enough for you to make money on the calls? Who's been down that road? Because I have. And while I cannot, and nobody should be 100% accurate going forward, understanding that rule is going to help you make more money when you're right and lose less money when you're wrong. All right. So when I look at a USO and I want to say to myself, all right, well, what is out there? All right, I'm going to click on options on my options tab. And let's think about this for a second. Okay. Let's think about this for a second. How long is the pattern in oil? Is it a weekly pattern? No. Is it a monthly pattern? No. It is a 5-month pattern. It ends in July. So I'm not going to be looking at March options or April or May. I need to get out there into July. And so when I'm looking at my options, and I'm looking at different options to trade, I'm going out there and I'm saying, all right, I need to get to the July options. I want to open those options up. Those are the ones I need. I need to see the call options in July. I don't care about the options that are happening, that are expiring this week. I could care less. So when I'm looking at these options that expire in July, the next thing is, all right, where are my option prices? Here's my bids and offers. Right now, the 87 call options for July are $6.30 by 8. Notice when I'm at the 6:30 area, the circle is in red. That's I hit that if I want to sell that option. But if I want to buy the 87, I'm going to be looking at the bid. And if I hit the bid, then I buy that 87 call. And when I click on it, immediately I've got some information over here that shows me, oh, okay, here's what it's going to cost you. Mid price is about $715. This is July 17th, 2026, 87 call. Okay, great. I got all that information available, but where's the risk graph? All right, well, I got a risk curve right here. When I click on it, I get the risk curve front and center. Let's slide some of this down so I can see the chart a little bit more. And I've got the chart here in front of me, and I've got my option price in front of me, and I can blow this out, and I can see exactly what my reward to risk ratio is. All right, notice as I'm moving around, that black line, that's your expiration. The red line is today. Every other line is what ifs. Well, what if it goes, where is it 105 days to expiration? Because it's 137 days, folks, between now and the July expirations. But each of these lines represent a different time frame to expiration, with the black going all the way to 0 days to expiration. So this is all important stuff that we need to know as well. Okay. Now, what if I'm looking at this, and I already gave you my synopsis. I think oil prices are way too expensive, so I wouldn't just go buy a call option on these. In fact, I talked a little bit about this in my oil and energy presentation I did. So take a look at this. You see here the 87 call. What did I say? It's going to cost $7.15 or $715. Huh. Okay, so how do I get the break even on that? You take the 87. This is the part where I get big. You take the 87 and you add $7.15 to that, right? So think about it. What's 87 plus 7? What's that give you? 94. Okay. Add 15 to that, $94.15. And that's where we need USO to go by July. All right. By mid-July, just to break even. If we're going to go all the way out to the 0 day to expiration. That's my break even at expiration. Wow. So if I want to double my money on this trade, because this is, unfortunately, and we all had to go through this. I did it. I mean, if you're able to leapfrog past this mistake, God bless you. All right. But most of us go through this area where we think options are, they're just like a stock, but they're cheaper. And then we got to realize the hard way, why do I keep losing money when the stock goes higher? Well, it's because you're not looking at the second and third dimensions of options. Options are price, time, and volatility. All right. Most people can't get past price before they're out of money and they're on to the next lottery ticket, whatever that might be. You get past price, you start thinking about time, and then you really have gone past, at least 80% of option traders. And you're in that top 20% because you're thinking, wow, I got to be right on price, but I got to be right on time too. So you realize quickly that it's got to make its move by a certain time frame, or I need to get out of this thing well before options expiration. And then factor volatility into it, you realize quickly whether you're overpaying or underpaying for options and what are your options on your options. And the first thing I could think of right away is, well, what if we sell some of that high premium? What if we can turn this right here into a call spread where we're helping to finance our buy with a sell? Let me show you how that works. So I've got already, and this is not a recommendation. We're just going in and I'm just showing you how you can evaluate things with the right options analytics tool. So right here, you've got a long call. Let's blow that into a call spread. So what I can do is I can come right down here, right? where my strategies are. Let me move this up a little bit so that we're able to see the options a little bit better. So if I'm long the 87 call, if I sold a call against that, I higher strike call. I'm going to take in less money, but I'm also going to reduce my overall cost because it's a vertical position, right? So vertical position means, I'm buying lower, selling higher. Now you might be saying to yourself, well, Tom, I see the 87 calls and then I see 88, 89. Where's all the rest of them? Well, they're here. You just got to go dig them up. So up here where it says strikes, I can go to 12 strikes, 18 strikes, 24 strikes, or every single strike that's out there. And when I look at every single strike that's out there, yeah, that's going to bring up a lot of strikes. But I can bring that back up and I could say, oh, there they are. There's the 88, 89, 90, 95, 100, 105, 110, 115. Okay, so if I'm long the 87, let's say maybe we're looking at this and saying, well, if I'm long the 87, maybe I might want to be short the 90, okay? That's going to be a 3-point bull call spread. You take 87 and 90, subtract that, that's 3 points. What's this going to cost you? Remember, if I'm going to sell an option, I'm going to hit the bid. See the red? Hit the bid. Now I'm +1. I'm long the 87 call. I'm short the 90 call. That's a 3-point spread. What's that going to cost me? Now, it's going to show it to you in mid-price, okay? And mid-price looks like this. So my mid-price, let me blow it up for you. There you go. Buy to open, 87 call. Sell to open, 90 call. That debits $65. Now, I know mid-price, I'm going to have a tough time getting $65. But I will say this. I've gotten mid-strike before, especially if it is a high volume and a thin bid ask. This is not a thin bid ask, but could I get 75 cents? Could I get $1 for this? Yeah, you can work, when you go and actually place the order, you can work with how that order is to be placed. But I'm telling you right now, if you start with an estimate, then you know what you're going in. You know what I call this? But using analytical option tools is like using the Zestimate on Zillow when you go to buy a house. We didn't have that kind of information before. We didn't have an idea what a house was worth. And you had to actually go to a broker, and then based on the broker's experience, they're able to give you an idea of what they think a true valuation of that house is. We're now able to do that. We're able to do that with the correct option software. Okay. And so there you go. So now you have this information at your fingertips. It's a matter of now visualizing it on a risk graph. So I'm going to visualize this on the risk graph right now with you. So I'm going to pull that risk graph in, and we're going to take a look at it. And this is a 65, this is 65 cents. So by changing the prices around a bit, all right, I'm able to take this graph and manipulate it a little bit better. But there's my bull call spread. All right, there's my lower strike, and here's my higher strike, and here's all the risk to reward inside of it. All right. Now, again, I'm really just scratching the surface. I wanted to show all of you out there what, just the beginning of what this is, we're able to do with this. I've got the ability over here on the right-hand side, how I'm able to create a prediction, all right, on the chart. I'm able to create a prediction on the chart, a time and price prediction, click on that, and then come over here and hit scan, and it's going to give me all types of option ideas based on where I see the stock going and how long it takes to get there. So now it's going to give me options based on my parameters, right? And just like that, all right, just like that, it gives you that information. And then I'm also able to go in and get an idea of, well, what if I only want to pay $500 or less for my trade? It'll factor that in. It'll factor in the cost. It'll factor in things like Greeks. If you want to look at option trades that have a specified delta, for those of you that know something about options, you can put in minimum, maximum deltas. You can put in minimum, maximum days to expiration. You can put in open interest volume. There's a lot of different things you can put in, but what this does is it will immediately factor in the target price and the target time if you push it on the screen. And there's a tool in here that allows you to put that target price and time in. It automatically puts that in for you. And then it now eliminates stuff you shouldn't be looking at. And that's what this does. All right. It does a lot more than just that. You know, I'm able to come in here and look at scans. I can look at the money calendar, and I'm going to save the money calendar for another day because this is a special feed to our members. There's also scans we can go look at. There's particular option scans. I can look at option scans. We just added another new scan today. I've got scans in here to tie in with our mastery and our partner programs. Right. So as you learn those and you become members of those, we unlock these scans as part of those packages. So that's all in here as well. Right. It's all centered around ideas, too. Not only community ideas, but even fundamental ideas, the beginning themes, ideas, different members that come out here in an interactive community. Something brand new. It's a big leap from what I was using just last month and over the last, 28 years now. So I want to welcome all of you. And I want to let you know this as I close out the day. For those of you that were options analysis / OptionX Platinum / Tom's Option Tools members, all right, you're going to be getting a special link this week. All right. It's going to give you access to all the services that you had before. All right. But within the new platform. And we're actually doing a free trial for you. And it's not a 1-week free trial either. It's a transitional trial. All right. We want to take you through a transition phase where we can show you how you used to do it and how you do it now. We're going to be doing that along with webinars, live webinars, which I will be hosting as well as the folks at Hub. So we're excited about this transition. We're not taking it lightly. I wanted to let all of you know that. And we're also going to be doing free trials for those of you that used to be Tom's Option Tool members that want to come back and see what we have to offer. So that is something that we want to do. It's like guys, I can only sum it up this way. Although the engine was strong, all right, we've been driving this antique car now, which has gotten us from A to B for decades. All right. It's now we're getting into something that has a lot more tech. All right. It's a lot more visually appealing and it features a lot more. Right. So check your email, check your inboxes. We're going to have a special link for those of you and it's going to be by design based on, what you did with us in the past. Your link is going to be for you. And so we're excited about sharing this with you again. Like I also said, we're going to have more stuff coming online almost on a weekly basis. And as we get together doing these live seminars, we're going to be opening up and sharing with you all the new stuff that's coming online as we enter in to this next phase of options analytics. All right. So thank you all for joining us. I appreciate it. Have a great rest of your week. Check your inboxes. We got a lot of stuff coming. I hope I don't flood you too much with all the information and education and analytics we have coming. But anyway, enough said. Have a great rest of your day. I'll see you soon. Bye now.